Stop everything. I need you to put down your coffee, close the door to your office, and turn off every single notification on your phone. Because what I am about to tell you changes the rules of the game so fundamentally, so violently, that if you do not understand it within the next few minutes, you are going to be left behind in the ruins of the old economy. It is Monday, January 21st, 2026. And while you were sleeping, while you were worrying about the weekend price action, the United States government just signed the death warrant for the comics. Ladies and gentlemen, Asian guy here, you're probably looking at your screen right now. You're seeing the paper price of silver hovering around $93. You're seeing the price in Shanghai trading at an absolute premium of $15.73. And you're probably thinking that that is the story. You're thinking that the $12 spread between East and West is the headline. You are wrong. That is just the background noise. That is just the symptom of a broken market. The real story, the one that nobody in the mainstream financial media is talking about because they are too terrified to admit what it means, is that a new player has just entered the chat. For years, we have tracked the whales. We have tracked JP Morgan. We have tracked the Chinese Communist Party. We have tracked the Indian housewives. We thought we knew who the biggest buyers were, but as of this morning, all of them have been demoted. A new Leviathan has just surfaced, and it has a printing press that can print infinity. We are talking about the United States government. We have just received confirmation of a massive, unprecedented policy shift coming out of Washington, D.C. Buried inside the latest defense appropriations language is a directive that should send a shiver down the spine of every short seller on Wall Street. The United States government has officially approved a $5 billion acquisition program specifically targeted at critical minerals to replenish the strategic national stockpile. And guess what is at the very top of that list? Silver. I need you to let that number sink in. $2, $5 billion. Now, in the context of the national debt, maybe that sounds like a small change to you. Maybe you're thinking, oh, they print $1 trillion a week. What is $2 billion? You are missing the scale of the physical silver market. The entire annual production of investment-grade silver is tiny. At current prices, $2. $5 billion represents a massive percentage of all the available silver sitting in the registered vaults of the comics. But it is not just the money, it is the mandate. When a hedge fund buys silver, they are price sensitive. If the price goes too high, they stop buying. They have a budget. They have risk controls. But when the United States government buys silver for national security, price is irrelevant. They do not care if it is $90. They do not care if it is $150. They do not care if it is $500. They have a mandate to secure the metal because without it, their missiles do not fly. Without it, their satellites go dark. Without it, the entire green energy transition that they have bet their political survival on collapses into dust. This is the moment we have been warning you about for 5 years. We told you that eventually silver would stop being treated as a speculative asset and start being treated as a strategic imperative. We told you that eventually the government would realize that they are naked. And that realization has happened today. Think about the timing. Why now? Why on January 19th, 2026, does Uncle Sam suddenly decide he needs $5 billion worth of metal? Because they have seen the same data we have. They have seen the inventory reports. They know that the United States is dangerously dependent on imports. We import roughly 6,400 tons of silver every single year just to keep the lights on. We rely on Mexico. We rely on Peru. We rely on supply chains that are breaking down in real time. And with the geopolitical tensions exploding, with the raid in Venezuela, with the trade war with China, the strategists in the Pentagon have realized that they are vulnerable. They have realized that if the ships stop coming, the American war machine stops working. So they are entering the market, but they are not entering a healthy market full of supply. They're entering a market that is already in the terminal phase of a shortage. Imagine a grocery store that has only 10 loaves of bread left on the shelf. There are 100 hungry people outside fighting for those 10 loaves. And suddenly, a billionaire walks in with a blank check and says, I am taking all the bread by order of the president. What happens to the price of the bread for everyone else? What happens to the availability? It vanishes. This $5 billion buy program is effectively a giant vacuum cleaner that is being turned on inside the comics vaults. It is going to compete directly with Apple. It is going to compete directly with Samsung. It is going to compete directly with Tesla. And it is going to compete directly with you. This is why I call it the new whale. But this whale is different. This whale makes the rules. And the scariest part is that this announcement creates a self-fulfilling prophecy. The moment the industrial users, the tech companies, and the solar manufacturers see that the US government is panic buying, they are going to panic buy too. They cannot afford to wait. If Apple thinks that the Department of Defense is going to corner the silver market, Apple is going to try to front run the Department of Defense. We are looking at a bidding war between the most powerful entities on planet Earth. And the prize is a tiny shrinking pile of metal that is rapidly disappearing. You have to understand the psychology of this shift. For decades, the US government sold off its silver. They dumped their strategic stockpiles because they believed in the just-in-time global economy. They believed they could always just buy what they needed on the open market. Today marks the official end of that philosophy. Today marks the beginning of the just-in-case economy. They are acknowledging that the free market has failed to secure the necessary resources for national survival. So they are intervening. And when the government intervenes in a commodity market, they don't do it gently. They do it with the grace of a bulldozer. This $5 billion is just the initial tranche. It is just the down payment. Once they start buying and once they realize how little metal is actually available, that number will grow. They will print whatever they have to print to get the metal. And this brings us to the most critical question. Where are they going to get it? If they go to the COMEX, they're going to drain the registered inventory to zero in a matter of weeks. If they go to the miners, they're going to lock up the future supply for years. There is no spare capacity in silver. The mines are bleeding. The grades are falling. The strikes in Mexico are shutting down production. So, the United States government is essentially announcing a hostile takeover of the global silver supply. This is the catalyst that changes the math from bull market to market failure. Because you cannot have a functioning futures market when the sovereign power is hoovering up the underlying asset. The shorts are dead. The banks who are naked short, the ones who sold paper, promises to millions of investors are staring at this headline and throwing up in their trash cans. They know they cannot cover. How do you cover a short position when the federal government is on the other side of the trade with a bottomless wallet? You can't. You default. So while the retail traders are looking at the $93 price on their charts and drawing trend lines, the tectonic plates have shifted beneath their feet. The price on the screen is irrelevant because it reflects a market that existed yesterday. A market where the US government was a passive observer. That market is gone. We are now in the era of strategic nationalization. And if you think this is bullish, you are understating it. Bullish is when people want to buy. Strategic necessity is when people have to buy or they die. We have moved from want to need, and the supply simply isn't there. But to understand just how desperate this situation is, to understand why the government is panicking right now, you have to look at the data that came out on Friday. You have to look at the numbers that prove the vault's already being looted before the government even writes the first check. We need to talk about the COMEX drain. We need to look at the mathematical impossibility of what just happened in a non-daily month. We need to dissect the corpse of the COMEX. You have to ask yourself a very simple question. If the United States government is suddenly rushing to buy $2, $5 billion of silver, what do they see that you don't? Do they see a healthy market? Do they see a market overflowing with abundance? No, they see the exact same thing that we saw on Friday afternoon when the CME group released their daily delivery report. They see a crime scene. They see a vault that has been raided, gutted, and left for dead. We need to talk about the COMEX death math because the numbers that just came out are not just bullish, they are catastrophic. To understand the magnitude of this disaster, you first have to understand how the futures market is supposed to work. January is what we call a non-Delhi month. It is supposed to be a ghost town. It is a transitional period between the massive December contract and the massive March contract. In a normal year, you might see a few hundred contracts stand for delivery in January, maybe a couple of million ounces changing hands. It is usually just the janitors cleaning up the floor. But this January, the janitors are gone and the looters have arrived. According to the official data released on Friday, the total deliveries for the January contract have now hit 44 million ounces. Let me repeat that number so it burns into your memory. 44 million ounces. That is 8,288 contracts standing for physical metal in a month that is supposed to be dormant. That is not a cleanup. That is a run on the bank. That is an enormous percentage of the available float being ripped out of the system in a matter of weeks. But the total number is only half the story. To see who is actually pulling the trigger, to see who is draining the blood from the stone, you have to look at the daily issues and stops report. This is the ledger that tells you exactly which bank is selling issuing and which bank is buying stopping. And the report from Friday tells a story of absolute desperation. On Friday alone, there were 345 delivery notices issued. That means 345 contracts said, I have the silver and I want to deliver it. And on the other side, who stood there with their wallet open to take every single bar? JP Morgan. Out of 345 notices, the house account of JP Morgan stopped 340. Do the math on that ratio, 98. 5%. JP Morgan didn't just participate in the market, they were the market. They stood there like a goalkeeper and caught every single ball that was kicked at the net. And who was on the other side? Who was the one desperately trying to cough up the metal? Bank of America. Bank of America issued 275 of those notices. This is a war between the banks. Bank of America is bleeding silver. They are the ones who are naked short. They are the ones frantically trying to find metal to satisfy the delivery demands. And JP Morgan, they are the vampire. They are sucking the life out of their competitors. They are taking every ounce that hits the floor because they know what is coming. They know about the $2, $5 billion government buy program. They probably helped write the legislation. So they are fronter running the United States government. They are draining the comics dry before Uncle Sam's check clears. Now, let's look at the death math. Let's look at how much time we actually have left before the system snaps. The most important number in the silver market is the registered inventory. Registered means the silver that is fully warranted, available, and ready to be delivered against a futures contract. It is the only silver that matters for the comics. As of the latest report, the registered category has dropped to roughly 120 million ounces. That sounds like a lot, right? 120 million. But compare that to the burn rate we just witnessed. We just saw 41. 4 million ounces disappear in one single month. A month that was supposed to be quiet. If you take 120 million and divide it by 41 million, what do you get? 9 months, less than 90 days. That is the timeline to zero. That is not a prediction. That is arithmetic. If this rate of demand continues, and we know it will accelerate, because of the government mandate, the comics will be physically empty by April. There will be no more registered silver to deliver. And what happens when the vault hits zero? What happens when a trader stands for delivery and JP Morgan looks in the vault and there's nothing but dust? It triggers a legal clause that is written into the fine print of every futures contract. A clause that most investors have never read. Force majeure act of God. Unforeseeable circumstances. Dearers, they will declare that they cannot fulfill their obligation to deliver the metal, and instead of giving you the silver you paid for, they will force you to accept a cash settlement. They will write you a check for the paper price, maybe $93, maybe $95, and they will tell you to go away. But by the time they write that check, the real price of silver on the street, the price to actually buy a physical bar will be $200. You will be cashed out at a loss. You'll be left holding fiat currency while the metal moons. This is the trap. The comics is designed to default. It is not designed to deliver this much metal. It works fine when the deliveries are small. It works fine when everyone plays the paper game. But when 8,000 contracts stand for delivery in January, when the US government enters the market, the paper game breaks. The leverage kills the casino. We are watching the countdown clock tick down in real time. January, 41 million ounces gone. February, another huge drain expected. March, the big month, the month where historically everyone stands for delivery. If we have 120 million ounces left now and we lose another 40 million in February, we enter March with 80 million ounces. And the open interest in March is already pointing to a demand of 300 million ounces. Do you see the problem? 80 million available, 300 million demanded. That is a default. That is a mathematical certainty. And the market knows this. Why do you think JP Morgan is buying everything? Why do you think they are stopping 340 contracts in a single day? Because they want to be the ones holding the physical when the music stops. They want to be the ones who hold the force majeure card, not the ones who get played by it. They are cornering the market right in front of your face. And while New York is playing this dangerous game of musical chairs, there's another player who has already decided to flip the table over. There's another market that has looked at this death math and decided that the price is wrong. We need to pivot to the east. We need to talk about Shanghai. Because while the COMEX is trying to suppress the price to $93 to save the banks, China has lost control. They tried to rig it. They tried to stop the rally, and they failed spectacularly. Let's look at the $15 reality. Let's explain why the arbitrage is about to suck the remaining life out of the American system. This is the moment where the rubber meets the road. This is where the theoretical price of silver collides with the physical reality of the metal. And the result is a violent explosion that is tearing the global market apart. We closed the last segment by telling you to look east. We told you that the COMEX is being drained, but you have to understand why it is being drained. It isn't just vanishing into thin air, it is being sucked into a gravitational vortex that has opened up on the other side of the planet. We need to talk about the Shanghai Gold Exchange. We need to talk about the $15 price tag that is currently flashing on the screens in China. For the last month, we have watched the Chinese authorities try everything in their power to stop this rally. They are terrified. They see the same shortage we do, but they are trying to manage it with rules and regulations. Last week, the Shanghai Gold Exchange issued an emergency directive. They slashed the position limits for traders. They cut the maximum allowable position from 7,000 lots down to 3,000 lots. They effectively told the market, you're buying too much. Stop hoarding. Slow down. In a normal market, that kind of regulatory crackdown would crash the price. It would scare the speculators away. But this is not a normal market. How did the price respond to the crackdown? Did it drop? Did it stabilize? No, it ripped higher. It smashed right through the psychological ceiling and hit $105.73. This is the ultimate signal of a broken market. When the regulator tries to slam on the brakes and the car actually speeds up, it means the engine is no longer connected to the driver. It means the demand is not speculative, it is existential. The Chinese industrial giants, the solar panel manufacturers, who produce 80% of the world's panels, did not stop buying just because the government changed a rule. They can't stop buying. If they stop buying silver, their factories shut down, their workers go home, their contracts with the West get canceled. So they looked at the new limits and they just bought more aggressively. They realized that the government's panic was a confirmation of the shortage. If the authorities are trying to ration the metal, it means the metal is running out. So the limit down order became a buy everything signal, and this creates the nightmare scenario for New York. This creates the arbitrage vacuum. Right now, as we speak, you can buy a paper contract on the COMEX in New York for roughly $93, but you can sell that same physical ounce in Shanghai for $15. That is a spread of $12 per ounce. That is a risk-free guaranteed profit of nearly 13% just for moving the metal from point A to point B. Do you understand what that does to the global supply chain? It acts like a giant magnet. Every single bar of silver that comes out of a refinery in Switzerland or a mine in Mexico or a vault in London is looking at those two prices. Where are you going to send your metal? Are you going to send it to New York to sell it for $93? Or are you going to put it on a plane to Shanghai to sell it for $15? The answer is obvious. The metal flows to the highest bidder. The metal flows east. This is why the COMEX inventories are collapsing. This is why JP Morgan is stopping every single delivery notice. They are trying to build a dam to stop the river from flowing out to sea. But the dam is leaking. The arbitrage is too strong. As long as that $12 gap exists, the COMEX will continue to bleed until it is dry. New York is effectively becoming a discount store for the rest of the world. The only way to stop the bleeding, the only mathematical solution, is for the price in New York to rise. It has to rise to meet Shanghai. It has to gap up by $12 overnight just to reach parity. And that is assuming Shanghai stands still. But Shanghai is not standing still. Shanghai is moving to 110, then 120. The West is chasing a ghost. But while we are watching this titanic battle between the nations, while we are watching the US government enter the ring and China break the limits, there's another casualty in this war. There's another sector of the market that is quietly suffocating, unnoticed by the institutional giants. We have to look at the little guy. We have to look at the retail investor who just wants to buy a few coins to protect his family. Because if you think the shortage is only affecting the billion-dollar vaults, you're dead wrong. The contagion has officially hit Main Street, and we have the letter to prove it. We need to talk about APMEX. We need to talk about the largest online bullion dealer in the United States and the significant failure that just occurred inside their private mint. Because if you are planning to buy your silver next week, you might find that the store is already closed. Let's go to the boots on the ground. Let's read the confession. This is where the story stops being about numbers on a screen and starts being about the reality in your hand. We have talked about the United States government. We have talked to JP Morgan. We have talked about the Shanghai Gold Exchange. But you are probably sitting there thinking, okay, but I can still go online and buy a coin, right? The shop is still open, right? Wrong. The shop is not just closed. The factory behind the shop has just exploded. We have to talk about the bombshell that dropped this weekend from the largest online bullion dealer in the United States. We have to talk about APMEX. And we have to talk about the letter signed by the CE. Oh, Ken Lewis, that is currently circulating in the private inboxes of the biggest clients. This letter is not a marketing update. It is a confession of a catastrophic failure in the retail supply chain. According to the internal memo, APMEX is currently facing a demand surge that is 4 times the normal volume. They are experiencing the 3rd busiest week in the entire history of the company. Now, normally that would be good news for a business, but in the physical silver market, too much demand is a death sentence if you cannot get the supply. And here's the terrifying part of the letter. Ken Lewis admitted to a significant development, which is corporate speak for a disaster at their private mint. You have to understand that APMEX relies on their own branded products for roughly 90% of their bar and round sales. They don't just sell eagles. They sell their own metal to keep the premiums lower and the volume high. But the letter reveals that due to this mechanical failure or supply issue, They are being vague on the details. Their production capacity has effectively collapsed by 50% overnight. They have half the metal they expected to have, and they have 400% more customers trying to buy it. Do the math. Demand is up 400%. Supply is down 50%. That is a recipe for a total market freeze. And APMEX knows this. They know they cannot fulfill the orders. So what did they do? Did they just raise the price? No, they did something much more ominous. They built a wall. As of this weekend, APMEX has instituted a mandatory $500 order minimum. This is the velvet rope being put up in front of the lifeboat. If you're a small investor, if you're the person who saves $50 a week to buy one Silver Eagle or one generic round, you are gone. You're locked out. They have effectively told the little guy, "We do not want your business. We cannot handle your business. You're too small to save." They are prioritizing the whales. They are prioritizing the bulk buyers because they don't have enough inventory to waste time shipping single ounces. This is exactly what we predicted in stage 5. We told you that eventually the market would bifurcate. We told you that the dealers would stop selling to the public and start rationing the metal. This $500 minimum is the first step. Next week, it will be $1,000. Then it will be $5,000. And then the website will just say, "Sold out." This is not a glitch. This is a systemic failure of the just-in-time delivery model. APMEX is the canary in the coal mine. If the biggest dealer in America, the one with the deepest pockets and the best connections, cannot keep their mint running and has to ban small orders, what do you think is happening to the local coin shop down the street? They are empty. They are ghost towns. And you have to connect this back to the macro picture. Why is the mint failing? Why can't they get the raw silver grain to cast the bars? Because JP Morgan is stopping 340 contracts on the COMEX. Because the arbitrage is sucking the metal to Shanghai. Because the US government is preparing to buy $5 billion worth of this stuff. There's no silver left for the retail mints. The feedstock is gone. So APMEX is essentially telling you the river has dried up. And this creates a panic loop. When people hear that they can't buy, they want to buy even more. The people who were waiting for a pullback are now realizing that price is irrelevant if the buy button is grayed out. So they are scraping together $500. They are borrowing money. They are rushing the gate. And this rush will only accelerate the collapse of the inventory. This is the definition of a mint failure. It is not just a machine breaking down. It is the supply chain snapping under the weight of a dying currency. The retail investor is officially being pushed out of the market. The window is closing on your fingers right now. But if you think the retail situation is bad, wait until you see the timeline for the institutional collapse. Wait until you see how this retail freeze interacts with the government buy program to trigger the ultimate legal escape hatch for the banks. We need to talk about April. We need to explain why the calendar is your enemy. We need to talk about the inevitable force majeure. Let's look at the end game. This brings us to the most dangerous intersection in the history of the financial markets. We have mapped out the battlefield. On one side, we have the retail freeze, where dealers like APMEX are physically unable to mint coins and are locking out the small buyers. On the other side, we have the whale wars, where JP Morgan is battling Bank of America for the last scrap of silver in the vault. And hovering above it all is the new Death Star, the United States government, with its $5 billion buy order. Now, we have to put these pieces on a calendar. We have to look at the timeline because the math does not allow this game to continue indefinitely. We are not looking at a crisis that will unfold in 2027. We are looking at a crisis that has a specific expiration date, and that date is April 2026. Why April? Because of the brutal arithmetic of the COMEX delivery schedule. Right now in January, a month that usually sees almost zero activity, we have lost 41 million ounces. February is another non-dealy month, but given the panic we are seeing, we can conservatively estimate another 30 to 40 million ounces leaving the vault as the industrial users scramble to front or run the government. That brings the registered inventory down from 120 million to roughly 80 million ounces by the time we wake up on March 1st. And March is the big one. March is a primary delivery month. It is traditionally the month where the biggest contracts expire. If January, a quiet month, took 40 million, what do you think March will do? The open interest for March is already massive. The demand is already baked in. If the holders of those March contracts stand for delivery, and they will because the arbitrage to Shanghai is $12, they will demand 80 million ounces, or 100 million. They will demand more metal than exists in the registered category. This is the mathematical wall. You cannot deliver what you do not have. And when the vault hits effective zero, which happens when the only metal left belongs to clients who refuse to sell at any price, the exchange has only one option left. They have to declare force majeure. Now, most people hear that term and think it sounds like legal jargon. They think it doesn't apply to them, but force majeure is the trapdoor that is waiting beneath your feet. It is the clause in the contract that says if we cannot deliver the metal due to circumstances beyond our control, like a government seizure or supply collapse, we reserve the right to settle your contract in cash. Read that again. Settle in cash. This is the nightmare scenario. Imagine you bought a futures contract at $93 because you wanted to secure 5,000 ounces of silver. You did everything right. You identified the trend. You bought the dip. You held the contract. But when April comes and you ask for your bars, the comic says, sorry, we're out. But here's a check for $93 per ounce. You get your fiat currency back. But what is the price of real silver in April? By April, with the vaults empty and the government panic buying, the price of a physical bar on the street, if you can find one, will likely be $200, maybe $300. So the comps gives you $93 and the real price is $200. You have technically been made whole in paper terms, but in reality, you have been wiped out. You missed the rocket ship because you held a ticket for a seat that didn't exist. And do not think for a second that the government will save you. The $2.5 billion buy program is the catalyst for this. Default. The government wants the metal. They do not want you to have it. If the comics declares force majeure, it actually helps the government. It clears out the speculators. It forces the paper hands out of the market. It leaves the remaining physical supply available for the Department of Defense to seize under the Defense Production Act. This is why I call it a hostile takeover. The government and the banks are effectively colluding to close the casino and confiscate the chips. JP Morgan takes the physical. The government takes the physical, and the retail investor gets a check that bounces because of inflation. This is the April event. It is the moment where the price of paper and the price of physical silver divorce permanently. We are already seeing the cracks with the $12 spread in Shanghai. We are seeing the cracks with the $500 minimum at APMEX. But in April, the crack becomes a canyon. There will be no price discovery anymore. There will be a reference price on CNBC that says silver is $100. And there will be a real price on the black market that says silver is unobtainable. You do not want to be holding paper when that split happens. You do not want to be the person waving a check at an empty vault. So the timeline is set. We have less than 90 days before the primary delivery cycle breaks, the back of the exchange. We have JP Morgan aggressively cornering the float in January to prepare for this exact moment. And we have the United States government entering the market with a bottomless wallet to accelerate the drain. The window is not closing. The window is practically shut. There's only a sliver of light left. And that leads us to the final conclusion. What do you do on Monday, January 19th? How do you position yourself in front of a steamroller that is moving at maximum speed? You don't trade, you don't gamble, you secure the asset. Let's wrap this up. Let's give you the final marching orders for the week, because every hour you wait is an hour closer to the force majeure. Let's finish this. So here's the verdict. We have laid out the evidence. We have shown you the death math of the comics. We have shown you the confession letter from Pimex. We have shown you the $12 arbitrage gap in Shanghai. And most importantly, we have introduced you to the new whale that has just splashed into the ocean. The United States government with its $5 billion mandate to secure the physical world. The picture is not complicated. It is terrifyingly simple. We are watching a simultaneous supply shock and demand shock hitting a market that is already running on fumes. We are watching the perfect storm that we have been warning you about for years, and it is all converging on a single point in time. Spring 2026. You have to understand that markets like this do not reverse. When the United States government decides that a commodity is a matter of national security, the price does not go down. When JP Morgan decides to corner the market and stops 98% of the deliveries, the inventory does not magically reappear. And when the largest retail mint in America cuts production by 50% due to a critical failure, the coins do not just show up on the shelves next week. The trend is locked in. The destination is zero. The destination is a world where silver is no longer something you can buy with a click of a button. It becomes something you have to fight for. It becomes something you have to know someone to get. It becomes unobtainium. So, what is your move? What do you do on this Monday morning while the rest of the world is still asleep? Do not look at the chart and wait for a pullback. Waiting for a pullback to $85 when the Shanghai price is $15 is insanity. It is like waiting for a discount on water while your house is on fire. The price on the screen is a lie. It is a trap designed to make you hesitate. It is designed to keep you on the sidelines while JP Morgan and the Department of Defense clean out the vault. Do not fall for it. If you can find physical metal, if you can find a dealer that still has inventory and will ship to you, buy it. Pay the premium. Pay the shipping. Pay whatever they ask, because the premium you pay today is the cost of admission to the lifeboat. Next month, that premium might be 50%. In April, when the force majeure hits, that premium might be infinite because there will be no metal for sale at any price. We are witnessing the end of the paper era. We are witnessing the death of the illusion that you can print wealth. The United States government knows it. That is why they are buying. The Chinese know it. That is why they are hoarding. The billionaires know it. That is why they are fleeing. The only person who doesn't know it is the guy watching CNBC who thinks silver is just a volatile rock. Do not be that guy. Do not be the person who holds a paper contract and gets settled in cash when the hyperinflation starts. Be the person who holds the bar. Be the person who holds the only asset that has no counterparty risk, no printing press, and no master. This is your final warning for the month of January. The 41 million ounce drain was the gunshot. The APMEX letter was the scream. And the government buy program is the bomb. The explosion is here. The window is closed. If you are in, you are in. If you're out, God help you. This is John A.G. The whale has arrived. The vault is empty.